Hey, everybody. The Fed's vote to hold the rates steady for the interest rates. And they're saying that it has to do with the uncertain impacts from the Iran war. This was a little bit expected when the war began. So just to let you know that that's pretty typical. So they voted in an 11-1 committee to keep the benchmark federal funds rate anchored in a range between 3.5 to 3.75%. The policymakers are navigating their way through higher than expected inflation readings. So there's mixed signs on the labor market and a war. And in its post-meeting statement, the Fed made a few changes to its view on the economy with a slightly faster pace of growth and higher inflation projections for the full year. So, what does that mean? We know that they're keeping the rates steady right now. The war implications are uncertain. But what they're also saying is that there is faster economic growth seen. So the Fed officials see gross domestic product increasing at a 2.4% pace this year, a bit faster than in December. Growth is projected to progress at a solid 2.3% rate in 2027, up 0.3 of a percentage point from the previous outlook. They also upped their inflation outlook for the year. They now expect the personal consumption expenditures price index to reflect a 2.7% inflation rate, both on headline and core. However, they do see inflation falling back to their 2% target mark in ensuing years as the impact of tariffs and the war fade. They also continue to expect a 4.4 unemployment rate by year's end, despite a string of weak payrolls readings. Now, President Trump is still badgering the Feds to drop their interest rates, but them increasing the rates was to be predicted. So originally they had mentioned about 3 rate cuts, 2 larger and 1 smaller rate cut this year in 2026. However, it does not look like that is going to be the case anymore. But the Feds have left the door open for future rate cuts, and we might see a second small rate cut later this year. One thing it states here, and I want to remind you of this, it says, although the Fed does not dictate mortgage rates, its decision impacts what it costs borrowers to take out loans for home purchases. As a result, the Fed's moves today are being closely watched by experts and real estate professionals, many of whom are eager to make sense of the spring market. So, even though mortgage interest rates are based on the 10-year Treasury yield and not the interest rates that the Fed sets, the economic uncertainty that we are seeing right now does affect the mortgage market. So keep that in mind. Take care, everybody.